Joining us for more right now in the markets is Liz Thomas. She is SoFi's head of investment strategy. And Liz, it's good to see you.
Good to see you too.
All right, let's talk about where things stand. We are ending the third quarter. We're heading into October. Some people think it could be spooky, but hey, we are looking at the markets near all-time highs. In fact, if we open at these levels, probably push us back above all-time high levels. How do you feel about things overall?
Well, I mean, the spookiness that we talk about in markets has been talked about since the end of August, heading into September and this seasonally weak period that usually happens in September and October. I think right now, when we look at just the longer-term bull market and the direction of travel being northward still in markets, we would expect there to still be breakdowns in beta along the way. And yes, things feel extended. Yes, they feel frothy. Yes, the market has been going up for a long time, but that doesn't mean that it has to come back down and suddenly be over. I still think there's time in this bull market to go, but I do think that we'll have some of those pauses and some of those breakdowns, let's call it in the 10 to 15% range throughout the bull market that continues.
Okay, people look at this and say, okay, it's starting to feel like the 1990s. You have financing that's coming through. Obviously, these companies are different. They actually have profits and revenue. How do you judge that comparison?
Well, I mean, even if you map it against the 1990s, we're probably not at the end. We're still probably somewhere in the middle of that range. And if you look at just the extended period of time that the 90s lasted on this enthusiasm, obviously about the internet, not AI, but the enthusiasm lasted for the better part of 4 or 5, maybe even 6 years before it turned over. And then overlay actions of the Federal Reserve on top of that. Right. Things still went just fine through what we would consider an adjustment cutting cycle. So the Fed cutting because they can, not because they have to. And actually the market continued to rally even as the Fed started to hike rates again later in the 90s. So we've still got time here.
And your point is you got to be in it at this point.
Yeah.
You know, I don't want to go back to Chuck Prince, but you got to dance while the music's playing. You think the music's going to be playing for quite a while.
I think the music can continue to play for quite a while. It's difficult to find something on the radar that can derail this in the near term, right? Okay. Valuations alone probably not going to derail it entirely. There would have to be an event, but that's always a risk, and you can't invest looking for the next event. So yes, I do still think there's time, and I think that investors have to be what I'm calling prudently present, right? You don't want to pull all your money off the table, but this isn't necessarily a time when everything's at all-time highs to be throwing a ton of new money in front of it. I think you can still wait for some of those periods, like I talked about before, the breakdowns in beta that are likely to occur.
What do you think does eventually puncture this, aside from the passage of time?
Well, I mean, we all know the quote, right? Bull markets don't die of old age. They're killed by the Fed. So if we start to see the economy reheat again, right now we're still in cooling mode. If we see it start to reheat again and the Fed is successful at this adjustment cycle where we get it to some sort of neutral rate, and then we start to hear about inflation heating back up, maybe even wage pressures heating back up, and the conversation shifts from cuts back to when do we start hiking, that's when you have to get concerned. And this period, obviously there are a lot of different schools of thought. Should we take the rate down quickly and get to neutral, or should we do it more patiently in measured fashion? This period is going to be really critical to make sure we don't overheat it and drive a bubble, so to speak, into that popping zone. Mm-hmm. Right now, I think we're okay. And as long as things stay patient and measured through at least the first half of 26, I still think that we can be successful at it.
Some of the sectors you like include financials and healthcare. And financials, obviously, a lighter regulatory touch seems to be certainly helping all of those stocks. Healthcare, there is some political risk to play into this, depending on where you go. But, you know, we're facing a deadline right now for the drug companies to come up with their own list of how they're going to cut drug prices before the government imposes it on them. How do you handle that political risk factor?
Yeah. Well, I'm certainly not the first person to say, like, financials, so we don't necessarily need to talk about that. But the healthcare piece, I mean, it comes up on the radar just in the last few months because it was so low. It was, you know, how can the valuation go any lower? It was in the first percentile versus the S&P. Mm-hmm. So it's attractive from that perspective because you're trying to put money to work. Where can you do that and get what you're paying for? The other piece of it is healthcare at the end of last year started to go down and had a really rough start to 2025. I think a lot of the bad political news was priced in at that point. Can it still go lower? Yes. but I think much of it had already been priced in, and there's likely to be some volatility. But I think healthcare as a sector has bottomed, so to speak. It went through that process, and as we know, bottoming is a process. It went through that process, and now I think it's okay to start putting money to work there, especially if you're looking for other opportunities for growth outside of tech, because biotech, pharma can be those places.
What about China? Why China at this point? We did hear of the beige report for, Leland Miller was on talking about how their economy is starting to show signs of improvement, but he thought some of it was maybe manufactured by the government pulling some things forward.
Sure, that is going to happen, and obviously there's always going to be an element of how reliable is the data that we're getting out of China. But I still think they're going to fight in this AI race, and we're going to continue to get announcements from China tech companies about trying to pull ahead, and there's going to be increased competition in that space. And along that way, they may not win, but along that way, there's upside in that market on the optimism that it could happen. And then if you just look at the economy of China in general, still struggling, still in a deflationary zone, I think the government will continue to stimulate until they start to see more signs of life.
If you're right on that, if China makes these advances, I can see how that would help China, but wouldn't it at the same time hurt our stock market, just like DeepSeek did with NVIDIA and the entire market getting drawn down?
The capital, yes, the capital would shift, but I do think that because China had started from where we've decided that they're not going to win this place, I think that there's upside in that competitive environment as it increases.
Without taking too much out of the U.S. at the same time?
Yes.
Okay, and gold, when I looked earlier, gold was at another new high this morning. What do you like about gold, and what makes you think that that continues?
Gold has defied logic through most of this cycle. It's outperformed stocks. I think there will continue to be appetite for gold. We've obviously seen quite a bit of a run-up already, but there will continue to be appetite for gold as we see currency volatility around the globe, as we hear about central banks perhaps moving in different directions or at least at different speeds, and as we worry about just the fiscal situation of a lot of countries around the globe. And the big buyers of gold aren't going anywhere anytime soon. The retail investor has come in and started to perk up their interest in gold, which I think has helped support it. So it's a spot in the portfolio that I think you can use for diversification. Are we going to see another 20 or 30% year in gold? I doubt it. But I also don't think we would see a drawdown along the lines of what you'd see in a stock market or some of the beta breakdowns that we talked about earlier.
Okay.